Welcome to our quarterly market update from John Giordani, the Chief Investment Officer at Planning Solutions Group. Volatility continues, but warmer weather has led to a rebound in asset prices. Let's jump in and take a look at the current markets. For the first 6 weeks of the new year, investors did nothing but sell risky assets, including stocks. Investors have been overwhelmed with negative headlines over the past year. Worries have included European debt issues, a strong U.S. dollar, a slowdown in China's economy, collapsing energy prices, and now a presidential election. The bad news has taken its toll, and at one point this year, the average U.S. stock was down over 34% from its 52-week high. Since then, it's been a complete reversal, and prices have rebounded significantly. Investing sometimes takes an iron stomach. The first quarter certainly shows why. Let me emphasize one thing. Bear markets are not uncommon. There have been over 30 of them the past century, one every 4 years or so. We know what they look like, and the worst thing you can do is let them derail your plan. Since 87% of the time stocks are in bull markets, the bigger risk to you as an investor is being out of the market and not avoiding a bear market. During our last update, we spent a lot of time looking at the risks that were bothering investors. Let's examine now why prices have rebounded. China's economy has stabilized, and the slowing economic growth and debt concerns have moderated for the time being. Oil, which was down 70% from its high prices, stopped declining and has rebounded to nearly $40 a barrel. Janet Yellen and other Fed members backpedaled on rate increases. Markets had expected 4 hikes this year, and now we may only see 1. Easy money and liquidity help fuel speculation, and money is moved back into risky assets. While economic growth is weak, we didn't enter recession, which many feared. And lastly, fear levels and investor sentiment hit levels not seen since 2008. Markets were so oversold, just like a coiled spring forced down to unsustainable levels, a bounce was a given. Let's spend some time looking at investors' worst enemy, his emotions. Think about a year ago. Stock prices in the U.S. were at record highs. It felt good to take risk. As prices continued to rise, many wanted to add stocks. I can't tell you how many clients we talked to that wanted to do this. When we asked why, it was because prices were going up and other asset classes like bonds were boring and not earning much. Fast forward to the first quarter of this year. As prices spiraled down, a reality check set in. Many of these same clients called and wondered, is it time to get out? Why? Well, they couldn't take the news and watching the value of the portfolio go down. They wanted to get back in when it felt okay. The problem with this strategy is when it feels okay, assets are usually much higher. Timing the market based on how you feel, buying when it feels good, and selling when it feels bad is a recipe for disaster. You should generally be doing the opposite. One of the main jobs of an advisor is to help you deal with your emotions and not make decisions in the heat of the moment. When you feel like Mr. Emotion is taking over, give us a call. Now, why would we want to buy high and sell low when we know it's incorrect? One behavioral trait is loss aversion. It's part of human nature. We are hardwired to seek pleasure and take risk when it feels good. However, studies have shown that the pain of loss is twice as powerful as the pleasure of gain. In down markets, the intensity of feelings is magnified and an investor really feels compelled to act. This is why it is important to prepare before you go into battle. Know how much risk is in your portfolio and have a plan to respond to difficult markets. Do not panic and overreact. Switching gears, looking at the economy, our long-term thesis has been a slow growth recovery. Growth has softened in the first quarter and is well below trend. Global economies also remain weaker than normal, not unexpected in a world where there is still too much supply and not enough demand. This is common after financial crises. It will likely continue to be a bumpy road, and if softness continues, we would expect no more interest rate hikes this year as the Fed hopes low rates spur loan growth and the trickle-down impact from this and higher asset prices make its way through the overall economy. Low growth economies and weak demand is also reflected in corporate earnings. Earnings season is upon us, and it looks like this will be the fourth quarter in a row where corporate earnings are down. Estimates look like this will be the worst quarter since '09, as a 10% drop in earnings is expected. The impact of the strong US dollar and weak energy prices are negatively impacting earnings, but as the year progresses, this will lessen if prices remain where they are now. This will be a welcome relief to companies. We do need to see an acceleration in revenue growth and earnings to support asset prices going forward. Let's take a look at stock markets and valuations. The US stock market is slightly overvalued, while international stock markets are more attractive to us on a valuation basis. While I understand the fears on the international markets and the appeal of the US market as it is a safe haven, I believe longer term there is a significant opportunity in overseas stocks. No one cares right now, but however, we have seen the widest outperformance of US stocks over international stocks in years. At some point, reversion to the mean will occur. Over full cycles, the performance of US and international stocks has been pretty close, so I would expect before all is said and done for the gap to narrow. Many clients have had questions about the upcoming election. A couple of points on this. Yes, I agree, it has been more entertaining than a reality television show, but why are we so polarized right now, and what is the appeal of non-traditional candidates leading in several races? The chart here looks at wages over the last 30 years. The average person hasn't seen their income grow in 20 years. In a nutshell, this is why the Main Street versus Wall Street argument has grown. The rich are getting richer while the middle class struggles. People in both parties are tired of the same promises from career politicians and not feeling any results in their wallets. Another question is, how will major companies react to who is elected? Several team members, including yours truly, recently attended a seminar with a prominent political scientist who was fresh off a trip to Davos, where he met with many CEOs, COOs, and CFOs of Fortune 500 companies. Not one company executive stated that they plan to change long-term corporate strategy or plans regardless of who was elected. Lastly, historically, year 8 of a presidential cycle has been unkind to markets as the year progresses. On average, stocks have produced negative returns. This is a risk. Now, while the election certainly will increase volatility, we continue to focus more on fundamentals like valuations, earnings, and the overall economy. Think back to other past elections and how people shouted that the new president was going to ruin the economy. Just hasn't happened yet. Capitalism has always found a way to win out and will continue to do so. Let's summarize the key points of our outlook and investment policy. One of our core themes has been to expect volatility to jump. As uncertainty remains high and we ramp up into election season, expect prices to continue to remain volatile. As an investor, stick to the plan. It's been developed and put in place ahead of time so that your behavior doesn't take over and negatively impact your portfolio. We continue to favor high-quality stocks that pay income over speculative ones. We believe income continues to be an important source of returns. Established companies that pay dividends have weathered the storms before and will likely continue to do so going forward. The recent sell-off highlights the risks of owning more speculative stocks, as these companies' prices remain down in many cases much more significantly than the overall market. We still also believe in having defense. Markets are not as cheap as they were 5 years ago. Defense gives an investor an opportunity basket to sell and use those proceeds to take advantage of low prices when the time comes. As opportunities present themselves, be prepared to reposition the portfolio, but don't move all at once. There are still many risks, and the environment has changed from the one that existed earlier in the cycle. Prices could go lower, so patience and moving slowly may be a better approach. This wraps up our current market update. If you have any questions, contact us at the number listed here. You may also access more information, including timely articles and your account information by visiting our homepage. Please watch for another market update in July. Thank you.